Good evening, ladies and gentlemen, and thank you for joining us this evening for our latest seminar, which is on the subject of the lifetime allowance. It's a subject you might have read about in the newspapers, and in particular, there's a lot more in the newspapers at the moment because it's been the subject of the recent Chancellor's budget. The title of today's seminar is Navigating a Window of Opportunity with the Lifetime Allowance. Talking a little bit about politics, as Ben Elton used to say, we're talking about the impact of the next election. We don't like to talk about politics too much here, but in this case, political ramifications often has an impact upon pensions, and in this case, we think there might be an opportunity that you should take advantage of. So, the presenter today is going to be Scott Gallagher, who is joining you in a moment. My name is Martin Stanley. I'm a Chartered Financial Planner with Rowley Turton, and I'm pleased to introduce our seminar today. Before we go on, a couple of things to say. Firstly, today is one of our more technical presentations. If you get a little bit lost in the slipstream along the way, don't worry. The slides will be available to everybody, and more than that, we encourage all of you to speak to us in person, and we can talk you through your own particular situation. So before I hand over to Scott, a couple of housekeeping points. Can you make sure your microphones are muted, please? Otherwise, we'll get a babble of conversation, and your camera's off. And at the bottom of your screen on Zoom, you should see a Q&A feature. If you have any questions, please type them in there, and we can answer your questions at the end. There'll be a recording of this presentation available to everybody. And if you experience any technical difficulties, put a message in the chat box below and we'll do our best to help, although we're not technical experts here. Thank you for joining us today. And without further ado, I'll hand over to my colleague, Scott.
Thank you, Martin. My name is Scott Gallagher and I'm a Chartered Financial Planner with Rowley Turton IFA Limited. Thank you for joining us this evening. As you may be aware from Martin's introduction and hopefully from the press, the UK's lifetime allowance, which was a limit on the value of the pension benefits that you could accrue or more accurately take without paying a tax charge or an additional tax charge, should I say, has been scrapped in the recent spring budget. In this webinar, we'll explore the implications of the lifetime allowance charge, albeit it's expected to be gone, but we'll run through it and the changes to it going away. The impact of future political shifts. Labour are not happy with the scrapping of the lifetime allowance, and in fact, we described it as a tax break, essentially. So, for a tax break for millionaires, I think was their words. We'll look at the strategies for maximising pension savings within the current window. We'll hopefully help you explain the details of and understand the details of the scrapping and what it may mean to you. I say the impact of future government and what they may do, or future Labour government. Also, why the scrapping of the lifetime allowance charge is not the 55% tax saving that the Conservatives would claim or Labour would object to. We'll talk about some strategies for your pension savings within what we think may be a window of opportunity, including looking at contributions and withdrawals. I think both are valuable options for people depending on their circumstances, and why it's also crucial not to overlook the inheritance tax impacts when it comes to planning your pensions. So, 1 second. So spring budget 2023. It's quite a momentous budget in a sense for us as financial advisors and for you as clients. Number one, and for the main purposes of this seminar, is that the lifetime allowance charge was removed. Technically, it is still in place for this tax year, however, effectively at a rate of 0. So the rules all exist. There's still some paperwork to complete if you're taking your pension benefits this year regarding that, but effectively you're taxed at 0. And as it stands, that the lifetime allowance and charge will be removed completely for the following tax year, 2024-25. Interesting, it's gone, but not entirely gone, because those lifetime allowance levels will still limit the tax-free cash that you can take from your pension or pension commencement lump sum, to give its technical term. A couple of good things from a pension perspective in the spring budget was that the annual allowance increased to £60,000 a year. I'll come on to explain it in more detail, but it's basically a limit on how much you can pay into your pension with tax benefits and tax relief. And if you go over that, then the taxman essentially claws some of that tax relief back. And also there's the money purchase annual allowance, which is a restriction on what you can pay in your pension if you've taken benefits flexibly. That previously was £4,000 a year. That's gone up to £7,000. So these are 3 positive things for people with pensions generally. There were some negatives in the spring budget, and certainly for many of our clients. The dividend allowance was reduced, and the capital gains tax allowance was reduced. Those were negatives. So it was a budget of two halves, shall we say, some which was very good for our clients, some which was clearly negative for our clients. So I'll just give you a very brief history of the lifetime allowance, or the LTA in short. It was introduced in 2006 as part of supposed pension simplifications. Even at the time, we did not think this pension simplifications made things particularly simple. I think at the time I calculated all the number of pension schemes, and pension simplification, I think, got rid of one. But it also added some additional complications. So like many things from the government, the name is not always indicative of what it actually is. So the lifetime allowance introduced what was an effective cap on the value of your pension fund, or the value of your pension fund that you could acquire, or pension benefits more accurately, without incurring an additional tax charge. Previously on pensions, and there's two types of pensions I'll cover briefly in a moment, defined contribution schemes and defined benefit schemes, and I'll cover them briefly. Previously on defined contribution schemes in particular, there was a limit on what you could pay into them, but there was not a limit on what you could take out of them in a sense. You effectively have limited benefits from those. But what they did in 2006 is they introduced a very generous allowance for what you could pay into a pension. That became a lot more generous. I'll cover that in a minute. But I think an element to protect the government's tax take, as it were, they introduced a limit on the amount that you could take out of a pension, or the value of your pension funds. Originally 1.5 million, which is quite generous, would be a lot more today if it stayed at that level and you'd applied inflation on it. And in simple terms, if your benefits were above that lifetime allowance, you got taxed for those excess benefits, and you taxed in one of two ways. If you took those excess benefits as a lump sum, there was a 55% tax charge. Alternatively, if you took them as income and subject to income tax, there was a 25% tax charge. And you might think, well, of course, I'll take it as income and pay 25% tax rather than 55% tax. Now, of course, it's not that simple. If you take it as income, you've got to pay the income tax. And when you put the 25% lifetime allowance charge together with a assumed 40% income tax charge for a high rate taxpayer, you effectively end up at a rate of 55%. If your basic rate taxpayer, it's a little bit less, and if your additional tax payer is a bit more. So again, there was always an element of planning around how you took excess benefits. Lifetime allowance peaked at 1.8 million in 2010, and then successive governments and chancellors chipped away at it until last tax year, I suppose. It was at £1,073,100, nice round figure there. So originally 1.5, peaked at 1.8, should be more when you add in inflation, but actually it was just over £1 million before it was got rid of. Now, as I mentioned earlier, there's two types of pension schemes. I don't want to go into this in too much detail, but it's important to just understand how they work and how they worked in relationship to the lifetime allowance. So you have defined contribution schemes. These are generally stakeholder pensions, SIPs, SASs, personal pensions, things like that. Most auto-enrollment schemes where you have a pension pot. So you and your employer possibly pay in. You have a pension fund or funds, and you normally get a valuation statement. Often you go online and get a valuation almost any time of the week, really. And you will see your pot, and it will go up and down in line with markets, charges, and obviously what you pay in is a big influence on how much value of your pot is, and therefore what pension you may get. For lifetime allowance purposes and annual allowance purposes, actually, so lifetime allowance purposes, it's just the amount of the pot. So I mentioned the lifetime allowance was 1,073,100. So that is the value of a pot that you have before you have to worry about the lifetime allowance charge. And that includes any tax-free cash you might take. And in the annual allowance, which again was a similar how much you pay in, it was just based on how much you paid in that year or how much you and your employer paid in. Now, defined benefit pensions, generally final salary and career average type pension schemes. So if you're in the NHS and you've been in the NHS for a while, you've probably had both of those schemes, or if you're a teacher or something, they do not provide you with a pension pot as such, albeit some people have the option of transferring out. They instead provide you with guaranteed income, possibly with tax-free cash as well. The amount of income is generally based on your salary in service. And for lifetime allowance purposes, these are not valued at the amount of the pot because there technically isn't a pot, but it's at a calculation which is 20 times the pension that you take when you take your benefits. So if you took a £50,000 a year pension, that would be 20 times 50,000, so that would be £1 million pot, plus any tax-free cash or pension commencement lump sum that was payable at the time, which that would just be simply the amount. So if, for sake of argument, you had a £50,000 pension and a £250,000 tax-free cash lump sum, 20 times 50 is £1 million, I mentioned, tax-free cash 250,000, so that's 1.25 million, and that's a value. And obviously, if that's in excess of lifetime allowance, which it would be, then you would have a lifetime allowance charge to pay on that. So the next question is, okay, there's a lifetime allowance charge. Well, kind of when is it an issue and how do they know? There's 13 specific events that can happen to you or your pension that then trigger the assessment of your pension benefits, either the value of the defined contribution pot or the value of your pension and tax-free cash from a defined benefit pension, and that is then assessed against the lifetime allowance. We won't bore you with all 13, but the key ones cover taking your benefits, so how much benefits have you taken and how does that compare to the lifetime allowance? Reaching age 75, there's kind of a cut-off in a couple of scenarios that even if you haven't taken benefits, there's an age 75 test, or if you've taken benefits under drawdown, you get another test at age 75, which essentially taxes you again on growth within your pension that you haven't taken out. I can explain that in a bit more detail later on, but it's an important thing to be aware of, especially if you're using drawdown or if you haven't taken your pension benefits and you're heading towards 75. And then finally, dying before 75. So if you've got a pension pot, you haven't taken the benefits yet, so you've not had one of those crystallisation events, but you die and you die before 75, then again, the value of those pension benefits historically was assessed against lifetime allowance to make sure the government got any tax on the pot that it felt it was due at that time. Annual allowance. I mentioned earlier that at the same time lifetime allowance was introduced, we had the imposition or the amendment, I suppose, in a sense, of an annual allowance. So previously there were different rules on what could be paid into pensions. The annual allowance came in, was very generous for defined contribution schemes in particular. Originally was £215,000 per annum, which is very generous. Rising at £1,255,000 a year. There was also rules where you could manipulate the dates to some extent, and you can make effectively 2 contributions in the same tax year. And I've certainly reports of city investment bankers paying in almost £500,000 a year at one point. You couldn't do that every year, but there was certainly opportunity for a small time to do that. As I mentioned, it's now 60,000. Last year it was 40,000, but it's gone back up, but nothing to the heights that it was when it was first introduced. Important to note that for higher incomes, for very high earners, it is tapered. And if you're on a very high income, then you need to speak to yourselves or your accountant just to see where you're affected, because it might not be the 60,000, it could be a lower figure. Also, I mentioned earlier money purchase annual allowance. So if you've accessed your pension benefits flexibly in the past, you may have been, well, you're likely to be subject to the money purchase annual allowance, and then your allowance will be 10,000, not the 60,000. Worth pointing out that there is a carry forward option of unused relief. So as long as you've been a member of a pension scheme previously, if you haven't used your full allowance for, let's say, the previous 3 tax years, you can carry that forward. Again, somewhat complicated, but we can give you advice on that. Money purchase annual allowance. Essentially, this was, I don't know, another joyous thing the government introduced. So in April 2015, they made pensions somewhat better for people in terms of tax treatment and flexibility, which was all very good. I think the government got slightly concerned that people would take advantage of those flexibilities too much, as they would see it. And what they didn't want people to do is take money out of their pension, primarily tax-free cash and possibly income, and then be able to pay that back into the pension very quickly and get effectively 2 lots of tax relief. They introduced this money purchase annual allowance. If you're not taking benefits flexibly, you probably don't have to worry about it. But if you have, you need to be aware of it, because you can get caught out if you then forget that you're subject to this and then start paying in large chunks into your pension. Where it can catch people is change of circumstances. So you've retired, you've taken your benefits, you've no intention of paying into a pension again, no intention of going back to work again. you retire. I know you're a bit bored, work brings you up, once you come back, you've got some projects on, you go back to work, or you join a new employer, or you do some other project later on, and your new employer has a very generous pension scheme, and you become a member also automatically, not really thinking about it possibly. And depending on your earnings, certainly because the allowance used to be £4,000 till this year, then people could easily breach that by mistake, and then that would give them tax consequences, which you don't want. So again, you need to speak to a financial advisor or your accountant if you're affected by that. Now, when the lifetime allowance came in, there would have been uproar if overnight they'd capped your pension benefits at 1.5 million. Now, 1.5 million is very generous in lots of regards, and certainly was in 2006. But there were still people who previously had pension benefits in excess of that, or were likely to exceed it. And they'd been happily paying to the pension under the current rules, no attempt to breach the rules or take advantage. They were just utilising the rules done. And I think there would have been uproar if those people had been what would have been seen as retrospectively taxed, i.e. paying tax on money that previously would have been not subject to extra tax, still subject to income tax in the normal way, but not any extra tax. So what happened when the new lifetime allowance came in was there were a series of protections, numerous protections, and added to over a number of years as they've changed the lifetime allowance to protect different people in different ways. If you have any form of lifetime allowance protection, you should hopefully know about it and should have details of it and keep a record of it. It's important to note that even though the lifetime allowance is being scrapped or has been scrapped, it still plays a part for the purposes of tax-free cash calculations, and therefore any existing lifetime allowance protection that you have may still play a part for that calculation of tax-free cash. So you need to keep hold of the details of your protection, and you also need to exercise care to ensure you don't inadvertently break that protection, because that may reduce the amount of tax-free cash you can take from your pension. There is also some reports that, depending on how the legislation finally ends up, whether there's opportunities for people with some very clever planning to take advantage of those protections and actually increase the amount of tax-free cash they can take. Now, that's not a subject for today, but it is a thing that we'll be looking closely at as we move into this new world. So, okay, the lifetime allowance scrapped, or is it? Okay, the lifetime allowance, as I said, has been removed from this tax year, but it technically rate remains in force, but with no charge. So effectively, it's a nil charge, but it still means that if you're taking pension benefits, or we as financial advisors are assisting you with that, there's a lot of paperwork and filling in forms and confirming the lifetime allowance figures, which is fairly pointless because there is no lifetime allowance charge, but it is still a technical requirement to complete. It's being fully removed, or should be fully removed, from next tax year. But as I say, the lifetime allowance levels still remain effectively in place, but to limit the tax-free cash. So when the announcement it was being scrapped went through, we were kind of, oh, this would be absolutely amazing. If you've got a £2 million pension fund, you'll be able to get £500,000 in tax-free cash, not just over £250,000. That's not the case. So it does still bear a place for questionable reasons, but it's still in place. But there is a question: what would the new government do? So we put up the TARDIS there, and the argument is that Labour are looking to effectively go back in time and reverse this removal. Some arguments about how they may do it, and I'll discuss briefly how they might do it. But it's a point to bear in mind that we could be going back in time very quickly. So what might a new Labour government do? The polling station picture there. We've got a general election no later than 28th of January 2025. Can't see how we have one much earlier than that, given the current polling, but we've had a lot of elections recently, and so watch your space, could change. Now, Rachel Reeves, the Shadow Chancellor, Labour's Shadow Chancellor, described scrapping the lifetime allowance as a tax cut for the rich. It's not as big a tax cut as she perhaps fears, or that Jeremy Hunt would have claimed, and I'll come on to that in a moment, but it is still a tax cut. And Labour have pledged to unpick any changes. But interestingly, they have said they're going to introduce a lifetime allowance solution for the NHS, because one of the big reasons behind the spring budget and the improvements in terms of scrapping the lifetime allowance and increasing the annual allowance from 40,000 to 60,000 was that the NHS certainly had probably I would say recruitment, but actually probably more technically a retainment problem. A lot of public sector workers, but GPs and consultants in particular, were getting hit from two key tax issues, i.e. their pension benefits were causing them both an annual allowance tax problem and also in many regards a lifetime allowance tax problem. And also especially for GPs, because many of them are effectively self-employed and effectively were paying both the employer and the employee element of those contributions. So a lot of those people had expressing concerns about these tax charges, and there were certainly lots of stories of people who were effectively retiring or retiring early because they felt it was no longer worth remaining as a GP because the tax costs of being in the scheme were, eroding a lot of the benefits. And obviously it depends on individual circumstances, but we've certainly come across people that have not done that, and that was obviously creating a real issue for the NHS. So that's the reason, one of the reasons cited for scrapping the LTA, but it's also one of the reasons that Labour are going to, or said that they're going to introduce a specific lifetime allowance solution and presumably an annual allowance solution for the NHS staff. Be interesting to see how that works in practice, because of course, as much as it does clearly affect GPs and consultants, we also know of headmasters who've been affected. I'm sure the senior police officers and other civil servants, and I imagine there will be some arguments about who should benefit and the rights and wrongs of certain members of the public sector being excluded from that lifetime allowance or getting a special scheme, and other members not. And then of course if it expanded to all members of the public sector, then there will be a public sector versus private sector argument. So okay, how did the LTA work in practice? And you'll get a copy of the slides, so you don't need to worry about this. But essentially, if you had, Bob has a £1.5 million pot, we'll assume it's a defined contribution scheme, just keep it simpler. So under the old rules, and he's got no lifetime allowance protection, he could have a quarter of the lifetime allowance. So it's a quarter of £1,073,100, again, nice round figure, which was £268,275 as tax-free cash. The other 804,825, so the remaining 75% of his lifetime allowance, you could take as taxable income with no lifetime allowance charge, but income tax. Now the excess benefits, so he's 426,900 to be exact, of excess benefits. That was in excess of the lifetime allowance. So well, to some extent, you could have left that for some time and dealt with it later, which lots of people did. Lots of people said, oh, I'll take my tax-free cash and I'll take some income and I'll leave the lifetime allowance excess pot for another day, because until I get to 75, it's not tested unless I actually access it. And that's what a lot of people did do. But if he wanted to access it or needed to access it, he had two options. So he could take it as a lump sum, that's a 55% tax charge, or he could take it as income. He could buy an annuity, or he could designate it for drawdown, pay a 25% lifetime allowance charge, but then the money he took as income, either by way of annuity income or drawdown income, will be subject to income tax. And as explained earlier, if he was a high rate taxpayer, that effectively equates back to 55% tax. But if he was a basic rate taxpayer, it'd be less than 55. And if he was additional taxpayer, it'd be more than 55. So again, there was some planning opportunities around that. So the lifetime allowance charge, if he takes it as a lump sum, is 234,795. So I like simple figures, so call it 235,000 and change. So okay, so now there's no lifetime allowance. Well, okay, why don't you say 55%, Scott? I said at the start of the seminar that it's not the 55% tax saving that Jeremy Hunt might claim, or the 55% tax rate that Rachel Reeves might be concerned about. It's actually around about 15%, again, depending on your tax position. That's because those excess benefits, the rest stay the same. The 25% of the old LTA figure still take as statutory cash. So yeah, it's strange, but it's still, that lifetime allowance figure still has a place. It's still remaining in the system as well, not completely forgotten about. The balance of 75% is, you can take as income, and the excess, the 426,900, can also be taken as income, but of course that's then subject to income tax. So again, if we assume that Bob is a high rate taxpayer and he takes over a number of years, so he doesn't push himself into the additional 45% tax band, he's still going to pay 170,760 in income tax. So he's not getting it completely free. So his choices in simple terms are 170,760 under the current income tax rules, versus the 234,795 he paid under the old lifetime allowance charges, or he might pay if Labour reintroduced the lifetime allowance charges. So there's a £64,000 or 15% tax saving. That's a great, nobody's going to object to saving £64,000 in tax, certainly not Bob. But it's not the 55% tax saving that he was promised or might have thought he was getting from the announcement, or that Rachel Reeves might be concerned. It's a good tax saving, don't get me wrong, but it's not 55%. And that's important when you look at other impacts of taking your benefits. So do we need to be careful? So why don't we just say, well, hang on, we were going to pay 55% tax on the excess benefits. We could possibly pay 40 or 45% if we take it all in, one lump sum, depending on the size of excess benefits. And surely 40 or 45%, Scott, is better than 55% if Labour win the next election and reintroduce the lifetime allowance charge. Well, there's a number of reasons you want to be cautious. Firstly, as I mentioned, there is income tax on taking those income benefits. And we don't know who might win the next election. And if you don't draw access benefits and you die before 75, then generally it's tax-free. So there's a reason for not doing it and not triggering income tax today. Certainly not rushing to do it without fully understanding and considering the impact of that. Secondly, and I'll just go back and income tax. There are a couple of little tax traps you can get in with income tax. So number one, the 60% band. If your earnings are over £100,000 to 125 and change, you end up in a 60% tax band, which is obviously worse than 55. So you need to be a bit cautious on that. Secondly, I mentioned earlier about triggering the money purchase annual allowance. They might not be concerned about that in one sense. You might say, well, okay, I'm going to take the pension benefit. It's got £1.5 million pot. Why am I bothered about paying money into a pension? Well, if there's no lifetime allowance today and it isn't reintroduced in the future, it might be a very good idea to continue paying in your pension, even pay as much as you can, whereas taking money out would limit what you can pay. So that is a point to be aware. And as I mentioned earlier, your circumstances can change. You could get a new job, new career, whatever. So you always need to think about that. Perhaps more importantly is loss of tax-free growth. So the money in your pension, even if you had a lifetime allowance charge issue, and even if Labour reintroduce it, the money within a pension is still growing tax-free. Yes, there's tax when you come to take the benefits, either income tax or possibly lifetime allowance charges if it's reintroduced. But if you take that money out, but it's growing tax-free in a pension, if you take that money out of a pension, the ISA allowance is only 20,000. So we use Bob's example where we're taking out, over 400,000, even after the tax, he's got, a £250,000-ish lump sum. If he starts to put that into ISAs, even if he's married and what, it's going to take him 12 years to get into ISAs and get it all tax-free. So it's going to sit somewhere in a bank account or an investment or something, and it's going to switch to income tax in the meantime, which it wouldn't be in the pension, and it's going to be subject to capital gains tax if it's invested, and you trigger the gains. So that's another factor. And then finally, and probably most importantly for our clients, there is inheritance tax trap as well. People don't always think about, and some of our clients are very thankful that have spoken to us about this before taking their benefits. So what is this inheritance tax or IHT trap that I talk about? Well, most assets that we hold are subject to inheritance tax in the UK. So houses, investments, savings, cars, other properties. Businesses generally, provided it's a trading business, is exempt. Buy-to-let properties generally not exempt. But importantly, pensions are generally exempt from inheritance tax. So all these things on this side are subject to 40% inheritance tax. Slightly confusing that we've got lots of 40%, but in this case it's inheritance tax. Whereas your pension pot is not subject to inheritance tax. There will be tax issues, income tax and possibly lifetime allowance tax if it's reintroduced, but not inheritance tax. There are certain scenarios, if you transfer pensions and die very quickly, you can, but generally that's not a factor. So what we're saying is you need to exercise some care if we're taking money out of the pension pot, which is inheritance tax-free. Even if you're taking it as tax-free cash, you're not paying income tax on it. But if we're then putting it into the estate, and then you're going to pay 40% tax on it, inheritance tax when you die, we need to just exercise a bit of caution to say, well, are you gaining or losing in that scenario? So again, we go back to Bob with his 426,900, unfortunately not a round figure, of excess benefits. So he's worried about the lifetime allowance. So he takes it over a couple of years, hopefully misses the Labour getting in and changing rules from that perspective. And he pays 40% inheritance tax. So the increase in his estate, having paid £170,000 inheritance tax, is 256,000 and change. Whether that goes into a house, into an investment portfolio, cash, whether he buys any real asset, apart from perhaps depreciating assets, he's got a bigger estate. So if he's already got an inheritance tax problem, or this creates one, he's facing possibility of paying 40% inheritance tax on that extra 256,000. So that's 102,000. So his actual beneficiaries will only receive 153,000. Now, if Bob's comfortably under 75 and dies under the current no LTA rules, his beneficiaries would get the whole 426,900. So there's a big loss. And when you add up the income tax charge and the inheritance tax charge together, you effectively get a 64% tax charge. And put very simply, 64% is more than 55%. So again, if we're taking action to save a 55% lifetime allowance charge, but then paying 40% income tax and then 40% inheritance tax, we're actually making ourselves or the family worse off. So we need to just, again, be aware of that. Okay, so how can we mitigate this IHT trap? Well, the one thing I didn't say, which I probably should have, which is don't take the pension benefits. That's probably the simplest way of doing it, which I should have added. But if you assume that you have taken the benefits or in the middle of that, the first thing is you can do regular gifts out of excess income. So Bob could take that income out of the pension, whether it's drawdown or annuity, doesn't really matter, pays the income tax on it. But if he gives that money directly to his family, so his children on a regular basis, standing order, sets up an investment account for them, a trust fund, something like that, then essentially there's no inheritance tax. As long as he's got excess money, as long as he's got more money coming in than he actually needs for his normal living expenses, then he can pass that out and there's no inheritance tax. That's an instant relief. So he still pays the income tax charge, but he doesn't pay the inheritance tax charge. That's a number one easy win for that. Alternatively, if he doesn't want to do regular gifts or doesn't have the excess income, but he still wants to give the money away to save inheritance tax, he can give it away, either again directly or indirectly via trust arrangements, and it's on what's called a 7-year clock. Most people listening would have heard of the 7-year clock. So essentially, you give the money away, and as long as you survive 7 years, there's no inheritance tax to pay. So if he's a good age and he's a young age, let's say, and he's fairly fit and healthy, he'll probably be fine that way. Third, you can invest in business relief assets, especially older clients like that. Essentially, those are specific assets that benefit from a relief called business relief. And what that means is that those assets are not subject to inheritance tax, provided you've held them for 2 years. So it's a 2-year clock in a sense. Also importantly, you don't have to give those assets away. The point is you hold those assets, but provided you hold them for 2 years, then the value of those assets is exempt from inheritance tax. So that then means that you've only got a 2-year inheritance tax problem on that money, not a lifetime issue. Fourth, spending. I'm often keen to encourage my clients to spend their money, and certainly if they are in a position where they've got what we would call too much. And effectively, if you've got an inheritance tax problem, you're getting a 40% off inheritance tax discount on that dream holiday. So if Bob and his wife had done the worldwide cruise, I can only remember the QE2 and Concorde. So from my young days when people used to win the pools and do that, and I'm not sure what the replacement is, but if you spent that £250,000 net on that cruise, well, obviously at the end of the cruise, he's had a fabulous time, I'm sure, a wonderful time, but there's no money left, so he can't pay any inheritance tax on it. So he's effectively getting £102,000 off the cost of that fabulous world cruise. And finally, you can insure against the inheritance tax. So you say, okay, well, I've taken money out of pension, Scott, I know that's an issue. Now my family have got to pay this £102,000 in inheritance tax. I've got an insurance policy that gives the family the money to pay it. So there's a cost to that. You've got to pay the premium stuff, so it's not completely free lunch, but it does solve the problem in a sense. Okay, so as I mentioned, so do we have a window of opportunity? Well, we're talking about a general election by January 25. I can't see the government wanting to do one early given the current polling, but equally I can't see them wanting to leave it to last minute. So it's probably before then. I think most commentators think it'll probably be autumn 24. So we've got a year and a bit, maybe a bit longer. Okay, so if Labour win, which they are currently likely to in the polls, I think it's fair to say, and if they reintroduce the LTA or do something new, which they've said they are going to do, well, when will the rules come in? They could technically do it from the moment they come in. It seems unlikely, seems more likely that they would come in, they would do a budget, and more likely that it would come in from the 25-26 tax year. But of course, we can't be certain. So we've maybe got nearly 2 years to act, but maybe shorter. So it could be an early election. And the current rules could change. It's worth pointing out on that if there's an election sooner and Labour win, and certainly if they win before the next tax year, Because the LTA is still on the books, as it were, in terms of legislatively, and it's just at 0%, it would be presumably fairly easy for them to effectively scrap the scrappage and then reintroduce the LTA by just continuing in effect and just get rid of the 0 charge to the 55% charge, as it were. So that would be more of a concern in that sense, and that would make a much smaller window for people to act. So, okay, so we've debated this a lot in the office when this came in and say, oh, okay, what can we do? Because again, we see the rule changes as you do, and it's confusing, and we have to kind of pause and look at it and work out, okay, well, what do we do and how do we know what to do? Well, the way we looked at it is there's probably 5 scenarios. So one is you do nothing and the LTA isn't reintroduced. And that's a scenario, and you can work out what the tax issues are when you might take the benefits with no LTA effectively. And that's scenario 1. Well, you can take actions. Next one, you could draw your pension benefits or pay more money in, and the LTA might not be reintroduced. So again, is that a good idea for you? And we work out the tax consequences of that. Where you can take action again, you would take money out of your pension or pay more money in, depending on your situation, and the lifetime allowance might be reintroduced. So again, we can work out that, and we can guesstimate what the tax position might be in that scenario at various points, and we can plot all that out for clients, and we've done that for a few clients recently. Or you could do nothing, and the lifetime allowance is reintroduced. So that's a 4th scenario. And again, we can plan that out. Or there could be whole new rules. That's a little bit harder to plan for, admittedly, because we don't know what those new rules might be. But the first 4, we can essentially work out what your tax position would be: income tax, lifetime allowance charge, if applicable, and inheritance tax for our clients. And we've done that for a few clients, actually, even before the scrapping of lifetime allowance. There was still an element of looking at the income tax and inheritance tax and lifetime allowance charge for clients. And we can then work out what the likely tax cost to you is of any of those 4 options. And then you or us can make an educated guess on what the likely outcome is of I don't know, the general election and change of government, etc., and what the impact is from a tax angle. And then you can make an informed decision. And I think that's the point. You need to know what's going to happen. One thing to say on the whole new rules point is, if they did introduce entirely new rules, it isn't impossible to concede that they might introduce it, and they might in a sense introduce a new form of lifetime allowance protection, same as was introduced in 2006 when the lifetime allowance rules first came in. And therefore you may have a window, rather than taking money out of your pension, you might have an opportunity to pay more money in, and that would also be the opposite of that inheritance tax trap I said about. You might be able to take money out of your estate, pay it into your pension, so reduce your inheritance tax bill, inflate your pension, and if Labour come in and say, all right, your pension benefits up till this point are now exempt from the lifetime allowance charge, this could be a perfect window of opportunity to pay money in. So it is a conflicted situation about whether you should be paying money in or taking it out. Right, so as I say, so what can you do? Like, 1, you could do nothing. It's a perfectly valid option, and certainly I wouldn't rush to make a decision, but again, you can do nothing. We can work out the tax consequences, and at least you know what the likely scenarios are, or tax implications of doing something or not doing something, and that's fine. And doing nothing is rarely the worst option, but it can be. You can pay more money in. So as I mentioned before, if they are going to reintroduce lifetime allowance and they happen to give you yet another protection that your pension funds at the date that the LTA is reintroduced are protected, that could be an ideal scenario if you've been taking advantage of this tax year, previous tax years by carry forward relief, and possibly next tax year as well, to boost your pension, get an even higher protected amount. But again, we don't know that's what they will do, but it's it's an option, and as long as you understand that nobody knows the future, that's fine. You could take benefits, i.e. you could take them out of your defined contribution scheme or your defined benefit scheme in order to take them now, avoid the lifetime allowance charge, as I mentioned, albeit with some income tax issues. That might be particularly beneficial for people with a defined benefit scheme, where it's much less likely that the lifetime allowance charge could be imposed on retrospectively, not impossible, but less likely. Or if you're buying an annuity, a guaranteed income for life. So annuity rates are higher today. More people are considering annuities than they've done in the last 10 years or so. And again, so an opportunity to take it, not have that 55% tax charge or a 25% tax charge on income, could be a very good window of opportunity. And finally, the 4th option, which is kind of undertake benefits but not fully, is you can designate pension funds to draw down. So you can essentially inform the pension provider that you are taking your pension benefits via drawdown, but not actually draw them. Now, there are some pros and also some cons of that. The first thing to say is that would be a benefit crystallisation event, one, which typically would be tested against a lifetime allowance, but there is no lifetime allowance charge now. So that would be a tick in the box in one sense of saying, well, I've already taken my benefits, even if you've not drawn any income out of it. So that if the Labour government came in and introduced it, you might find that out of benefits that you've already looked to take, as it were, and therefore they might not be subject to any reintroduction of lifetime allowance. However, there could be, but you don't actually have to take any income out of that pot until you decide to. So you've made an action which may protect you against a lifetime allowance, but you don't actually draw the income. You don't have to have the income tax problems, which is good. There is a possibility that Labour could change the death benefit rules on pensions. They've always been, been very generous for the last few years. And if they did that, that is more likely to affect pensions that have been designated for drawdown than pensions that haven't been touched at all. So there is always a danger that you're trying to solve one tax problem, you may create another one. And the other thing is that you still could be caught by another benefit crystallisation event, BCE 5A to get its technical title, which is this point I mentioned at the beginning. There's three key tests. There's when you take the benefits, when you get to 75, either on benefits you haven't taken or drawdown benefits, and when you die before 75. So in this case, basically, BCE 5A essentially looks to tax you on growth within the pension or drawdown pension that you haven't taken. So in Bob's case, he put 426,900 into drawdown. He didn't take it. It's grown very healthily. It's several years later, it's 600,000, made 170,000 pounds in profit. Is now 75. Then, because that what the government would see as excess growth under the old rules, that would be subject to a lifetime allowance charge, not the 426 he started with, but the extra 170 odd of growth. And again, that would be quite an easy one for the Labour government just to reintroduce the old rules and catch you. So they didn't catch Bob when he took his benefits or designated it, but he's left the money in and he hasn't taken out the growth, then he can get cut for this 55% tax on the growth. There's an easy way to not incur that, and we do that with clients anyway, or historically did, which is you take the growth, but then you've got the income tax charge on it. So you sit down on every year or so, you look at how you draw down pot, and if it's in a nice profit, you strip out that profit, pay the income tax, but you don't pay the lifetime allowance charge because it effectively doesn't grow because you're taking the growth out of it. So that's I suppose a fairly whistle-stop tour of the lifetime allowance scrappage and possibly reintroduction. I've tried to keep it as simple as possible, but it is a very complicated subject, and we are quite keen on trying to keep it simple, but I'm not sure how well we've achieved or not. And we mentioned in the introduction, and so the invite to this seminar, that we have a copy of the Enough book, which I actually have in front of me. So there. This is a book which isn't specifically about lifetime allowance at all, but it's about financial planning generally. And as much as we've talked about lifetime allowance and pensions a lot, for us, all financial planning and financial advice really should be tied to a financial planning perspective, because you really need to look at people's overall financial picture before making decisions, because there's a whole lot of stuff to consider, not just the tax. But if anyone would like a copy of this book, and we'll send it out to you for free, of course, if you could email my colleague martin@rowleyturton.com just with your name and address, and we will get one into the post as soon as possible. And thank you very much. Questions and answers. 1 second. Miss a slide.
Well, thank you very much for that, Scott, and thank you for those of you who are still with us after what was a more detail-packed session than normal. We know it can be quite complex, but after all is why we're here and what we do. So the key messages I think I took from what Scott told us was that anybody with a fairly large pension should really be taking thought to review things. Our message at Rowley Turton is usually think long term, but that doesn't mean ignore things along the way and walk blindfolds. And this might be one of those occasions where you really need to take stock and look at this. Scott's message was, don't rush into any of this. And certainly take advice from ourselves or your accountant or your own financial advisor, but certainly take the time to look at this opportunity, because you might kick yourself in 3 years' time when you realise that there was an opportunity to save an awful lot of tax. You probably won't want to do that on your own. You'll want to speak to a financial advisor. Hopefully you'll come to us, Scott or myself will be delighted to speak to you, come into the office, sit at the boardroom where I'm standing at the moment, have a cup of coffee and a biscuit, and we can go through things. We're always welcome people in to have a chat. So whilst we're talking, there have been a couple of questions asked, Scott, which I've been asked to send to your way. One of our participants today said, I'm lucky enough not to need all my pensions, and I've got several personal pensions that I've just left alone and sat there because I was told if I took them, I'd pay the lifetime allowance charge. Should I still do that?
Well, should still leave them? Again, it's difficult because of the other tax consequences, but this is certainly an example whereby not having acted has worked in your favour. So I mentioned in the presentation that Bob could have just left the excess benefits in place and not worried about the tax, and that's what many people did. Those people are certainly going to be delighted about the scrapping of the LTA. So had Bob taken his benefits last year and taken all of them and taken the excess benefits, then yes, he would have paid the 55% lifetime allowance charge, whereas now he might only pay a 40% income tax charge with it planning, maybe even less. Again, because of the other impacts, inheritance tax and other factors, it's not that simple. If you that's the complication really, and that's what we deal with on a daily basis. It's so many different tax aspects with this. You really need to sit down. I certainly think that if you've got a relatively small excess benefit and you don't have an inheritance tax problem and you're not really got an income tax problem, then there certainly would nudge you more down the line of perhaps it's a good window to take those benefits. If you've got an income tax problem and you're a high rate taxpayer or additional rate taxpayer, then the advantage of this window might be less. The difficulty is always you do not know what's coming in. So the new tax rules when Labour come in could be completely different. So
what you're saying there, Scott, is the person who asked this question is a prime example of someone who really should look into it more carefully. So the person who wrote that question, please come in and sit down with us. There's another question, Scott's here, which is somebody says that I know that if I leave my pensions, ultimately they can go to my family. And this person says that's why they didn't choose an annuity. So their pensions are sitting there. Can I give the pensions to my family earlier, spread it around? Can I give some of my pension to my sons while I'm still alive?
In essence, no. There used to be some ways with SASs and stuff where that was kind of technical. It was a bit very technical and complicated. But with pensions, effectively, no, you can't give them. You can get divorced if you're married and can get genuinely divorced, and then you can share your pension on divorce. But that's a bit extreme and a bit expensive for most clients, I would argue. What you can do is you can take the pension benefits yourself, pay the tax, and then you can make pension contributions for your kids. And there's certainly if your children are high rate taxpayers, there is an argument, certainly with no lifetime allowance, that you can take money out of your pension, you can pay 40% tax relief. You could give it to them or pay it into their pension, and again, subject to allowances and stuff, they could get the 40% tax relief back if all the numbers work perfectly. And then effectively, you've transferred your pension to them, but it's not quite as simple as here's my standard life pension. There you go.
Thank you, Scott. That's great. And last question here asked today is somebody says that they worked for a local company, had a final salary scheme. They think they were quite close to the lifetime allowance because they worked for a final salary scheme for many years. They haven't had their state pension yet, which is another £10,000. Is that going to take them over the top?
The state pension has no, I probably should have covered that. The state pension has no impact on the lifetime allowance. Essentially, what you're talking about is private or workplace pension schemes, in essence, UK schemes. So the state pension is not included in that calculation. Where it would be an impact, obviously, is possibly in terms of income tax. But if you were over the lifetime allowance or close to the lifetime allowance with a defined benefit pension scheme, we've got clients at the moment who's comfortably over. It's a huge win for him because he was looking to have a lot less net pension income with the LTA being in place. So he has had a win of several £1,000s a year when you work it out. So he is delighted about the removal. So
the message for him is it's very good news, hopefully for many others, but we need to be careful about this possible reintroduction and take planning accordingly.
Yes, definitely. I think take advice is the key takeaway message.
Well, that's all the questions we've got for the moment. I hope that if anybody has any other questions, they'll send them in to Scott and myself. We'll be glad to speak to you. In the meantime, remember that we'll be sending you a copy of this presentation so you can look at it again at your leisure and look at the slides, certainly, if you don't want to look at our ugly mugs. And only remains for me to say thank you very much for joining us today. We hope to do another one of these seminars on financial planning topics in a couple of months' time. So we hope you'll tune in then as well. Anytime, thank you very much.
Thank you very much, Martin. Good evening.